Assalamualaikum warahmatullahi wabarakatuh. Good morning, everyone. My name is Zaneta Salma. I am from Universitas Dian Nuswantoro, and I will present my article to the first International Conference on Business, Economics, Accounting, and Technology 2025. And first, I want to open my article. The title on my article is Tech Avoidance Analysis through Capital Intensity, Inventory Intensity, and Leverage. Background and problem on my article. Tech is the main source of state revenue, which is crucial in supporting development and public welfare. State revenue between 2020 until 2024, tech revenue provided a higher figure than non-tech revenue. The property sector has contributed 122.9 trillion or 7.2% of the total national investment realization. Companies are trying to inject in tech avoidance, which is vulnerability to illicit financial flows. And then there are research gap. Consists of the effect of capital intensity on tech avoidance, the effect of inventory intensity on tech avoidance, and the effect of leverage on tech avoidance. This research will re-examine previous research to support more effective tech oversight policies, promote transparency, and meet corporate objectives, as well as ensure fiscal aspirations and national economic growth. And objectives and method, independent variables in my article are capital intensity, inventory intensity, and leverage. Independent variable is tech finance. Hypothesis 1, capital intensity has a positive effect on tech finance. The higher the capital intensity, the greater the tech avoidance. Hypothesis 2, inventory intensity has a positive effect on tech avoidance. The higher the inventory intensity, the greater the tech avoidance. And hypothesis 3, leverage has a positive effect on tech avoidance. The higher the leverage, the greater the tech avoidance. And then there are measuring instruments of capital intensity variable, inventory intensity variable, leverage variable, and tech avoidance variable. The purpose of this study is to present empirical evidence regarding the effect of capital intensity, inventory intensity, and leverage disclosure on tech avoidance in property and real estate companies listed on the Indonesian Stock Exchange from 2021 to 2024. The research method used is quantitative research analyzed using SPSS 27 software. Data collection used for passive sampling and sorting in a population of 372 data with a sample size of 85 data. And then result and discussion on my article. All of hypotheses from hypothesis 1 until hypothesis 3, the conclusion are accepted. This table shows that the independent variables, namely capital intensity, inventory intensity, and leverage, have a positive and significant influence on tech avoidance in property and real estate sector companies listed on the Indonesian Stock Exchange from 2021 to 2024. The interpretation of result on my article, hypothesis 1 is accepted, and it means that the higher the capital intensity, the greater the calculated depreciation will be, resulting in a reduction in taxable profit, which has an impact on lowering the effective tax rate. This decrease in DTR indicates a higher level of tax avoidance. Thus, the higher the capital intensity, the greater the tendency of companies to engage in tax avoidance, which is reflected in the decrease in DTR. This finding is in line with agency theory because agents utilize flexibility in managing fixed assets to reduce tax burden in order to achieve the principal's goals and the agent personal interest. Hypothesis 2 is accepted, and it means that the large inventories increase storage, maintenance, and risk of loss costs, which are also recognized as expenses reducing pre-tax profit. This expense reduces taxable profit, thus reducing the tax burden, which is reflected in a decrease in DTR. The higher the inventory intensity, the lower the DTR, and the higher the level of tax avoidance. This finding is in line with agency theory because it benefits the principal. Because after tax profit increase, on the other hand, the agent also benefits because it appears to be able to reduce the tax burden and improve company performance, which has the potential to increase compensation or reputation. Then hypothesis 3 is accepted, and it means that high leverage result in debt interest expense, which is recorded as a taxable income expense. High interest expense lowers taxable income, thereby reducing the total tax payable by the company, resulting in a lower ETR. The higher the leverage, the lower the ETR, and the greater the tax avoidance. This is in line with agency theory because agents utilize financing decision debt to reduce tax burdens for the benefit of the principal while simultaneously securing personal interest. This indicates that the higher the proportion of fixed asset, investment in inventory, and use of corporate debt, the greater the tendency of the company to carry out the avoidance strategies, and this finding is in accordance with the agency theory used in this study. And the last implication of this on my article, theoretical significance. From a theoretical perspective, the findings support agency theory. And then policy significance. From a policy perspective, this result underscore the need for tech authorities to improve regulatory oversight and enforcement. And the last practical significance, business practices also need to adapt to encourage greater transparency and tech compliance. That's all my article. Good morning. Thank you.